Hi, everyone. I'm Rosemary Miller here with Tim Pagliara, the Chairman and Chief Investment Officer of CapWealth, here to discuss February's Consumer Price Index. Thank you so much for joining me today, Tim.
Good morning.
So, Tim, could you tell us what were some of the key findings regarding the CPI for February and how did it compare to expectations?
Well, inflation's stickier than people have expected. It's has not come down. And I think in the broad picture, what everyone's trying to do is fractionalize what is a much bigger problem. And it just take a second to develop that thought. I call it the common man CPI. If you go back to 2019, we had a $19 trillion federal deficit. We've got a $34 trillion federal deficit. The price of everything has increased 30 to 50% since that time period. So what we've done with inflation is we've brought it back down into the historical norms of 3.5 to 4%. But people aren't feeling it. So all you're doing is compounding off a much bigger number. And that's what's significant. And there are a lot of structural things in place that are going to make inflation stickier, higher for longer. For example, in that theme of how much more expensive everything is in the last 5 years, even though we're in a 3.5 to 4% inflation mode right now, people are still trying to catch up. And so when you look at labor contracts, for example, the Boeing contract that's out there now, it's a 3-year, 10% per year increase. This is what's happening with all the labor contracts as they attempt to catch up from this structural move in the cost of virtually everything. And so that's the problem. So I think what the Fed is going to do and how they respond to this is you're going to see them happier with inflation higher for longer. That 2% target's going to have to move closer to 3 to 3.5. And they're going to have to tolerate the inflation that we've survived under for the last 50 years. You look at 50 plus years of inflation data, and it's CPI is over 3.5%.
Yeah, I'm going to talk about you mentioning that people don't feel it. People don't feel like inflation is getting any better. And I certainly don't feel it. And you also tied it in with we're trying to catch up. Is that the real reason we don't feel it because we're trying to catch up? Or is it because things maybe aren't getting better?
Well, absolutely. Like I said, we have wrung all the inflation that we can out of supply chain issues and things like that. So try and tell the average family of four, let them try and tell you the difference between a 3.7 and a 3.8% CPI number. They're not feeling it, obviously. And
Right.
the cost of everything continues to go up. And there's a lot of things, for example, this is where economics and common sense, it's the intersection of economics and common sense. So housing has gone up tremendously. The cost of financing a home has more than doubled.
Mhm.
So how can people feel good about that on the same wage base that they had 3 to 5 years ago? That's why there's continued upward pressure on wages. And in any economic model, like I said a minute ago, wages and benefit costs are 2/3 of the inflation picture. And so we're going to go through a period of many years of adjustment with this. Fiscal policy is not favorable to the inflation number. For example, I heard a strategist from Lazard this morning talk about the 6% deficit, 6% budgets to GDP per year. Warren Buffett once said, if Congress passes a budget that exceeds 3% of GDP, except in a time of crisis or war, they shouldn't get paid. And so we are compounding 6% annual budget deficits to GDP as far out as the eye can see. Well, unless the economy grows, and grows substantially, interest on the debt will be 50% of all expenditures within 5 years. So the Federal Reserve's in a very tough position. They have to grow the economy. They have to tolerate a certain amount of inflation because of fiscal policy. And so it's not a recipe that is going to bring inflation down. And that's why the American families are not feeling it.
Right. We're certainly not feeling it. And you were mentioning housing costs and how they're increasing, obviously. You know, I've noticed that a lot of people are just renting these days. We're like in a renter's economy. Is that by choice because you have more flexibility with renting, or is that because we just can't afford houses?
I think it's kind of one of those all of the above. The biggest problem in single family housing right now is a shortage. Structural things that have not been taken care of since the financial crisis of 2008 have led to a shortage of housing. We're 5 million single family homes short. We have this wave of immigration, illegal or legal, that is also compounding the problem with housing. And so the price of housing's gone up, and people, whether it's a lifestyle choice or not, they're also very vulnerable in the rental market because taxes, insurance, all the other things that continue to go up, those are pass throughs in the rental market. There's no free lunch there either. And so, in our own market here, the rental market's very, very expensive, and housing as well.
Well, Tim, could you tell us from February CPI report that came out this morning, how did the markets react to that?
I think the market's going to shrug it off because, again, if you put it in perspective, the last 50 years, 3.5% to 4% inflation is what we've lived with. Now, what does that mean? Everybody's going to have to adapt. There's going to have to be innovation, productivity increases. That's the only thing that really can bring inflation down long term, and responsible fiscal policy. There's things that the federal government could do right now. Mortgage rates are typically 1.5% over the 10-year treasury. So if you put the 10-year treasury at a baseline of say 4 to 5%, then they should be the 10-year, the 30-year mortgage should be somewhere around 6%. It's 100%, 100 basis points higher than what it has historically been. They won't solve that problem until they recapitalize and release Fannie Mae and Freddie Mac. They can use the proceeds from that. The government stands to make over $100 billion from that recap and release. They can put that back into the housing system and create more lots, more building sites, more opportunities to increase supply. Because again, if you don't increase supply, all you're going to do is increase the inflation that follows. So that would be a big first step. There's other things that they can do, but it all comes down to fiscal discipline. So you have to align all these things before you're even going to begin to bring inflation down below 3% in a consistent way.
Well, Tim, is there anything else on your radar regarding February CPI that you believe should be on ours?
No, I just think it was a big to do about nothing. The average American family is not going to feel the difference of 0.1% either way. It's these big structural things that have to be addressed before we can have a really good conversation about inflation and reversing the feelings that average Americans have.
Well, thank you so much for joining me today.
You're welcome.